in about 30 seconds. Just wanted to allow others to make certain that the connection can be made. So I'm Ron Paprocki, CEO of Medicus Asset Advisors.
Hi, I'm Julie Kazan, the Vice President of Financial and Investment Strategy at Medicus.
So we'll be kicking things off for you very shortly, and we appreciate the time that you've dedicated to sit in for this session. I hope you find it to be informative and perhaps even a little entertaining. But with that, why don't we get started? Well, it is our pleasure to walk you through charitable planning, gifts that keep on giving. Managing appropriate planning strategies really plays an important role in helping the organizations you support receive your gifts in the most tax-efficient manner possible. Doing so generally encourages individuals to support organizations or increase the amount of the gift that an individual may provide. We find that charitable planning also plays an important role in total wealth management. Charitable planning is equally important as investment consulting work and the coordination of the efforts of your other advisors. We're going to have a Q&A session at the end of our session today. So please feel free to send in your questions. If you do so along through the process, we'll make certain that we can address them at the end of our session. So at this time, I'm going to hand it off to Julie. Julie, why don't you take it away?
Thanks, Ron. So let's take a quick look at our agenda. We will focus on two areas today: lifetime giving techniques, such as the various ways gifts can be made, and the limits you may want to consider as you plan your gifts. We'll also review estate plans and giving techniques, such as the various ways you can include gifts in your estate plans and what types of assets might be the most appropriate assets to consider for such purposes. There are several techniques individuals use for making charitable gifts. Some are very easy to execute but offer limited income tax benefits, such as gifts of cash, checks, or using credit cards, while others are a bit more complicated but provide potential benefits you might want to consider, such as gifts of appreciated securities, the use of donor-advised funds, qualified charitable distributions, or gifts of life insurance. Let's explore in a bit more detail. The easiest way for individuals to make gifts is to either donate cash, write a check, or charge the gift on their credit card. Very simple process to get an amount to your preferred charity. Gifts like this generally qualify as a charitable donation, and as such, might be able to reduce your taxable income and thus have the potential to reduce your income taxes. However, just because a gift can be considered a charitable donation does not mean you will receive a tax benefit because of the recent changes to the standard deduction available for many taxpayers. We'll touch on this a bit more in a bit. There are also techniques that you can qualify as charitable donations, just like the simple techniques previously described, but also offer the potential plus of additional benefits that can save you money or make your plans for giving much easier to accomplish. The use of donating appreciated securities, using a donor-advised fund, or using qualified charitable distributions all fall into this category. And let's look deeper into each of these. Appreciated securities are items such as shares of stock, mutual funds, exchange-traded funds, also known as ETFs, or real estate that have increased in value since the date of purchase. Such appreciation is usually not taxed until the asset is sold. Generally, the gain, very simply the difference between purchase price and selling price, is taxed at a long-term capital gains tax rate, typically at 15%. Some individuals may think they should sell such an asset so they can have the cash to give to their favorite charity. This could be a costly mistake. For example, let's assume an asset was purchased for $10,000. Over time, it appreciated to $40,000. If sold, as illustrated with Alana on the left, The gain is recognized and taxes are due in the amount of $4,500 or 15% of the gain. Appreciated securities can also be used for charitable contributions. The full value of the appreciated asset can be considered as a charitable gift, and thus no capital gains tax is due. For example, the full value of Marcos's appreciated security is available as the gift, or the full $40,000 can be donated to the charity of Marcos's choice. As another example, an appreciated security is donated to the charitable organization. The donor has a charitable deduction based on the market value of the security, and the charity sells the security. Because they are a charity, there is no income tax paid on the sale. A related strategy is found with the use of a donor-advised fund. This tool can be combined with the combination of appreciated securities and the ability to make gifts to multiple organizations in a very simple manner. Donor-advised funds are easy to arrange and can become very effective tax planning and charitable giving tools. Let's use the same example of the appreciated security we just described. Original investment of $10,000, current value of $40,000. However, rather than wanting to make a single gift to a single charity, let's assume you would like to divide the impact of the gift among many charitable organizations important to you. How can you use this asset to help multiple charities or make charitable gifts over several years? Let's see how a donor-advised fund works. Let's assume you own stock that has appreciated in value. If you wanted to give the value of the stock, you could sell the stock and pay capital gains tax, and the remaining value is available for contribution. However, you can also donate the stock to a donor-advised fund. The contribution of the stock can create the charitable deduction equal to the fair market value of the stock donated. Once received by the donor-advised fund, the fund can sell the stock and not pay any capital gains tax. Why? Simply because the donor-advised fund is considered a charitable entity. The proceeds from the sale can be reinvested, and then you are able to direct grants from the donor-advised fund to the charitable organizations of your choice. For example, the AASM Foundation or the Sleep Research Society Foundation. Of course, other various qualified charities can also benefit by such grants. Please be aware administrative fees and investment fees may apply, and it is important to consult with your tax advisor regarding your own situation. For those who are age 72 or better, you are probably aware that the government requires you to take distributions from your IRA accounts and possibly from profit-sharing plans or 401k plans. They allow assets in such accounts to not be taxed until you begin to withdraw the funds from your account. Assets in these accounts can be used to help you make more tax-efficient charitable contributions. Based on the current law, up to $100,000 in total can be directed to any number of qualified charities each year. By doing so, you are not required to claim these withdrawals from the account as income. Special attention should be required to maintain appropriate records in the event of an IRS audit. Just as a quick example, the IRA account owner instructs their account custodian to make a distribution in the name of the preferred charity. No charitable deduction is available, but no income tax is paid on the distribution. For our final lifetime giving example, let's consider the potential gift of life insurance policies. Why gift life insurance? Consider why you purchased the policy. What circumstances or individuals were you trying to protect? It is possible the reasons you purchased the policy no longer exist. If so, a gift of the policy can make sense. One reason many purchase life insurance is to create an estate. For example, let's assume you purchased the insurance to protect your young family in the event of your death. You needed to create an immediate estate so they would be cared for. Another reason many purchase life insurance is to preserve an estate. Estate taxes might have caused a substantial drain on assets in the event of your death. Insurance can be an effective tool to produce the liquidity needed to pay estate taxes in a relatively inexpensive manner. But now your previously young family has grown and all are self-supporting individuals. In addition, you have saved substantial assets. Mission accomplished, you have created your estate. The insurance is just not needed any longer. And recent tax law changes have lessened the burden of estate taxes, so much so that the need of life insurance may also no longer exist to preserve your estate. There are two basic ways to use life insurance as an asset for gifting. You can transfer policy ownership to the charity. Keep in mind, this is irrevocable. Such a transfer cannot be undone. The deduction is generally equal to the cash value, if any, of the policy. And of course, the question, who pays the future premiums to keep this policy in force until your death? Another option is to name the charity as the beneficiary of your policy. This is revocable, meaning you can change your mind in the future, and no deduction is available for naming a charity as the beneficiary. However, the policy is not part of your estate at death.
Great, Julie, thanks. Let me jump in here and address some of the tax implications of these alternative gifting strategies. Let's take a quick look. First of all, recent tax law changes created a $300 above the line deduction for qualified charitable contributions. In a nutshell, these contributions must be made in cash, cannot be used for those who itemize deductions, meaning they use the standard deduction, and cannot be used to fund donor-advised funds or 509A3 supporting organizations. Next, please consider that cash gifts to public charities are deductible if they do not exceed 60% of adjusted gross income. Now, for 2020, that limit has been increased to 100%, much greater opportunity to gift. Gifts of appreciated securities are deductible up to 30% of adjusted gross income. Now, if your gift exceeds these limitations, there is a 5-year carry forward period for you to deduct as much of the gift as possible. Let's get a better understanding of the concept of carry forward if a charitable contribution exceeds deductible limits of either type of gift. As an example, let's assume an individual's adjusted gross income is $200,000 and they contributed $100,000 of appreciated securities. The 30% limit of an adjusted gross income of $200,000 is only $60,000. Therefore, only $60,000 of the $100,000 contribution is allowable as a charitable deduction. The remaining $40,000 can be applied to the next year's tax return. Substantial charitable contributions can still be made with some income tax deductibility, but may have to be spread over a few years. Our final item to review is the standard deduction. This is an amount all taxpayers can use to reduce their taxable income, even if they do not have any deductible charitable gifts or other deductible expense. Currently, the standard deduction for a single person is $12,400. Married filing jointly, $24,800. This serves to reduce taxable income unless actual deductible expenses exceed this amount. Given we all have the ability to use the standard deduction, it's possible to bundle the benefit of using this amount, and doing so can also be used in combination with more advanced charitable giving strategies, such as a donor-advised fund. For example, let's assume in year 2020, a married couple has a charitable deduction of $14,800. In addition, they have other deductible expenses, such as mortgage interest or state property taxes of $10,000. Total deductions are $24,800, which happens to be the same amount as the standard deduction. If all remains the same for 2021, they will have the same amount of deductible expenses. Total expenses and total deduction for the 2-year period is $49,600. But what if they bundle their charitable deductions into 1 year rather than spreading out over a 2-year period? Well, the same total contribution of $29,600, just all made in 1 year. The result is a higher deductible amount in the first year and the use of the standard deduction in the second year. The result is an additional $14,800 of deductions with the same expenses as in the first example. It can make sense to bundle. Let's summarize the points presented so far. Consider creating separate entities, such as a donor-advised fund. This can be a simple way to potentially combine other strategies to make gifts to several charities. If over 72, consider the use of qualified charitable distributions as a tax-efficient method of making charitable gifts. Consider the use of appreciated securities for charitable giving. This helps you eliminate capital gains taxation on the assets. Finally, use of gifts of cash, checks, or credit cards as the last resort. These are so easy to use, but have very limited additional benefits. Well, let's start this final section of our session by offering perspective on estate planning. Then we'll wrap up with how charitable giving can play a role in your estate plan. First, why plan your estate? Well, there could be several reasons to do so, but the most typical reasons we identify are: you may feel it's an important task to provide income necessary to maintain a standard of living to surviving family or friends. You may want to make certain that the assets you've accumulated during your life are distributed to the people or organizations that are important to you. You may want to minimize the potential of estate taxation. Federal estate taxes have become much less burdensome for most individuals. However, these favorable laws are expected to sunset or change in a few years. In addition, states also have tax structures that should be considered. Finally, you may want to provide specific bequests or gifts to various charitable organizations that are important to you. Regardless of the reason why, the process can appear to be overwhelming. However, with appropriate steps, the seemingly complicated process becomes very straightforward. Let's look at the process. To begin, understand that as you accumulate assets, they fall into one of 4 basic categories. Personal property, such as cars, boats, bank accounts, or investment accounts. Next, real estate, your residence, a summer home or a winter home, perhaps a commercial building, office building, or apartment complex. Next, a practice or a business interest. These are unique assets that can be valued and distributed in various manners. Finally, tax-advantaged assets. These are assets with unique income tax treatment during life or at the time of death. Most notably would be retirement accounts such as your IRA, 401k, pension or profit-sharing plan, as well as life insurance policies. At the time of death, the bulk of these assets can be pulled into probate. Probate is a period of temporary receivership historically created to allow creditors an opportunity to make claims. Before assets can be removed from probate, taxes and expenses may have to be paid, and paid in cash, before whatever is left is available to the people you're primarily interested in, your family or friends. A question many ask is, how might these assets be protected so your estate planning objectives can be accomplished? Distribution of assets will do much to help accomplish your estate planning goals. There are various types of distribution methods. Let's take a closer look. Distribution can depend on several variables such as title of ownership, beneficiary designation, or legal documents. Ownership can be in the form of solely owned, jointly owned, as community property, or as tenants in common. Beneficiary designations are important to control assets such as life insurance policies, retirement plan accounts, or some bank or brokerage accounts that have a transfer or payable on death arrangement. These are specific arrangements allowing you to name a beneficiary for those types of accounts. Legal documents. A quick word about legal documents. They only control distribution if the form of ownership is appropriate and if there are not any beneficiary designations. This is a common area of misconception. Many individuals prepare elaborate estate documents that don't control distribution simply because ownership or beneficiary designations will supersede the control of legal documents. For example, a will typically controls distribution only if the assets are owned solely in one name, and if there is no beneficiary designation, such as payable or transfer on death arrangements. A trust will typically control distribution of assets that have been titled to the trust prior to death or that are paid to the trust at the time of death. Finally, let's take a look at taxation. Recent tax law changes have resulted in federal taxes becoming less onerous. However, there are substantial changes that are expected no later than the end of year 2025. States also can have an estate or inheritance tax. It's important to be aware of the laws of your state to determine what type of tax liability you may be facing. Please note, no federal taxes are assessed on transfers of property between spouses. Most states apply the same treatment. Estate taxes are generally assessed to property transferred to individuals other than your spouse. Now, how and when are estate taxes due? Well, all taxes are due and payable in cash within 9 months after death. Here's a simplified federal tax table for 2020. As you can see, there's a substantial amount of property that can be distributed to individuals other than your spouse without paying federal estate tax. Currently, the amount available is $11.58 million. Once you exceed that amount, taxes begin at 40%. Remember, this estate tax structure will sunset after 2025. In the meantime, Congress can change the estate tax law again. Julie, why don't you take over from here?
Thanks, Ron. Now that you have this basic information as it relates to an estate planning process, it's important to apply this knowledge based on your stage of life. For example, if you're in your early career phase, we typically see the following issues are key for estate planning. The identification of guardians, executors, and trustees is an important first step. These individuals are most likely going to play a role for a more extended period, especially if children or other heirs are young and will require management or income for an extended period. Identifying the appropriate needs for income provided to heirs is critical. In this case, evaluating standard of living requirements, potential education costs, and to what extent you may wish to fund retirement life will all be important variables. Next, identify available assets, especially those that can be used for income-producing purposes. Verifying beneficiary designations of assets that you have accumulated is also important. Next, identify possible life insurance requirements if the assets you have accumulated are insufficient to accomplish your goals. Next, address management needs, especially for early career physicians. The identification of people that can help manage assets and coordinate the distribution of income to your beneficiaries and potential bequests to charities is an important role. Finally, we see for early stage physicians, charitable planning as part of their estate plan is relatively rare. What if you're more mid-career? Once again, identifying the appropriate individuals to serve as guardians, executors, or trustees is an important first step. Income needs for survivors is important, even though income needs may be different from those that are in their early stage. Although identifying needs, available assets, and life insurance are still important steps. Verify the distribution of assets, especially when income may not be the primary concern. For example, children may have reached adulthood and are not requiring income to support their standard of living. In these cases, distribution of assets rather than production of income becomes a primary concern, and charitable bequests can be considered. Management is key even if not required for as long a period as in the early stage, and we see charitable planning becoming a little more common with mid-career physicians. Finally, for those of you that are in late career or already retired, the considerations are similar. Identifying the appropriate executors and trustees is an important step. Verifying distributions to survivors and understanding beneficiary designations is key to make certain your assets are distributed in the manner you wish. Understanding the administration of your estate and taking steps to avoid probate can be important as well. Taxation may be a more critical factor, especially after 2025, simply because the total value of assets may exceed the non-taxed amounts, and charitable gifts in an estate plan are most common in late career physicians. We typically find a current review of the total estate planning process is critical for those in late career or already retired status. This can be a simple process, but one that is important to verify that your plans will be appropriately executed. Charitable contributions can be an important part of an estate plan. Most typically, this would be a bequest to a worthy organization. It's also possible to establish donor-advised funds at the time of death so that your charitable giving can be continued. Some will also consider more advanced techniques, such as charitable remainder trusts or charitable lead trusts. If a bequest is preferred, you can consider some examples which should be reviewed with your lawyer before drafting your will or trust. Each of the following examples can be used depending upon the type of contribution you'd like to make. For example, you can make a contribution of cash of a specified dollar amount. You may prefer to contribute a percentage of your estate, or to give a residual amount after you've made specific contributions to family or friends. Or finally, you may decide to name a specific tangible asset, such as shares of stock, a piece of real estate, or other tangible property to a charitable organization. Just as the donor advised fund can play a part in contributions during life, it can also play a part in the estate plan. Rather than funding the donor advised fund during life, the funding occurs at the time of death by making a bequest to the donor advised fund. The same operation and tax benefits will apply, and grants can be made by individuals you have appointed to manage the donor advised fund. This can be an excellent way to include family members in an ongoing charitable giving strategy after you have died. In more advanced situations, you may consider the use of charitable remainder trusts. While typically not part of most estate plans, they may be effective for you. The process begins by contributing property to the trust, which results in a partial income tax deduction. The charitable trust pays income to you or other individuals during their life, with the remainder passing to charities at the time of death. Another technique is the charitable lead trust. These are structured to allow a contribution to the trust, which makes yearly payments to charities, and the remainder is paid to family members after the certain period. These are more complicated arrangements and do require careful legal assistance to make certain all is prepared correctly.
Well, thank you, Julie. Let's wrap up by recapping some of the items that we've discussed. Distribution of assets is key for all stages of career. Make certain that your assets are inventoried and that you identify your beneficiaries and charities. Administration is key for all stages as well. Probate should be avoided if possible and can be avoided with the appropriate titling and legal documents. Management becomes key for all stages to make certain that you've identified who needs such management what kind of management is required, and for what period. Income objectives should also be identified. Critical for early and mid-career physicians, especially when young children are part of the family. In these cases, it's important to also identify who would be in need, how much income is required, and for what period. Finally, taxes and charitable bequests. Key at all stages, especially as it relates to both federal and estate taxation. It also makes sense to consider the documents that will be used in your estate plan. Let's start with your will. Your will is a simple document that basically directs any assets that are not controlled by title or beneficiary designation. Usually a will leaves personal property to the surviving spouse or family members and will distribute any remaining assets into the trust arrangement if one exists. The living will may also be created. This document will express your preferences for life support. A trust, whether living, meaning created during your life, or testamentary, created as part of your will, can also play an important role. Remember, a trust can be in existence for many years and provide management and the vehicle for the distribution of income or assets to family, friends, or charities. Power of attorney documents are important to maintain as well. These can provide temporary authority to individuals to control property or healthcare decisions on your behalf. Finally, I suggest a document that has no legal significance, but can have tremendous impact on those that survive. I suggest you gather some nice letterhead, a good writing instrument, and lock yourself in a room for an afternoon. I suggest you write a letter. But not a letter like any you've written before. This will be a letter that will be read by family and friends after you've died. This is an opportunity for you to say one more time how much you love them, what you hope they'll achieve, and what happiness you hope they will find. It's a chance to say those things you may not ever had the opportunity to say. If you've ever been given a letter such as this, you'll know the impact it can have on a life. Well, there are resources available as well, and you'll find many of these on the websites that are being presented here, the sleepresearchsociety.org for the foundation, or the sleepresearchsociety.org. Also the foundation website for the Academy of Sleep Medicine, or the Academy's website. Please visit our website as well. We have information that may be helpful for you as you consider your estate planning and charitable giving objectives. I'd like to say thanks to our attorneys that provided us with this disclaimer, but most importantly, I'd like to thank you for your attention during this webinar. We hope it was informative, instructive, and that it will allow you to move towards accomplishing your charitable goals. Again, thank you very much. Well, we have a good opportunity to respond to questions that may have been posted. I know that one question that often is asked is the idea of, do I have to really make giving through an estate planning arrangement as complicated as it may appear in the session that we have here today? And the answer there is certainly absolutely not. There are various ways that you can make very direct gifts to the charitable organizations that are important to you, and you certainly can take advantage of those types of gifts as well. Another common question is there a particular type of asset that might be appropriate for you to give? And the idea there is that know that there are certain tax benefits of making gifts of retirement account assets rather than leaving those assets to other family members. Recent changes in the income tax law require that inherited IRA accounts or other retirement plan accounts be distributed by non-spousal beneficiaries over a 10-year time period. That's very different than the way the previous law read, which allowed one who inherited the IRA to spread distributions out over their lifetime. Well, the net result is that that 10-year process may find your beneficiary in a much higher tax bracket than before. With that in mind, if you're considering charity as part of your estate plan, you may want to consider using some of those retirement plan assets as part of a estate bequest to a charitable organization, because that is not subject to the same type of estate or income tax consequence as well. At this point, I'm going to toss it back to the folks with the SRS or the Academy. Didn't know if there are any other questions that may have come up that we might be able to respond to. Joe or Christine, were there anything else that you would like to offer out?
No, this is Joe from the ASM Foundation. I don't have anything else to offer. I think if you don't see any questions, we'll conclude this shortly. Christine Davis from the SRS Foundation, did you want to add anything before we conclude? I will take that as a no. Thank you, everyone. Thank you, Julie. Thank you, Ron. Thank you for Medicus for supporting us. And I will be ending this webinar now, and the recording will be made available to SRS members and ASM members as well. So thank you, everybody.
Well, thank you. We appreciate the opportunity to help.
Okay.